Okay, hello everyone, and welcome Kim, one of my favorite presenters here, Kim Lochridge from Engineer Tax Services. Welcome to the Kelly Grant and Tanis, as well as our investment podcast, which is Real Deal Investing, which we'll be posting this video on that channel. We're excited to have you here today. I know you presented to us about a year ago, and I certainly can't. I speak very highly about you, your services, the service that you give. I use you all every year for my depreciation on my properties and cost segregation services and all that you do. And you definitely service our clients very well. They always give 5-star reviews for you and are very appreciative after they work with you. So welcome. Excited to have you here presenting on secret tax savings that only sophisticated real estate investors use. So I'll hand it over to you here, Kim.
All right, sounds great. Thank you so much for the introduction, Jerron. It's always good to be back and to speak with you and your clients. So I'm not sure how many of you have were on the webinar last year. We do have a very similar, sometimes it takes 2 or 3 or 4 or 5 times listening through this to actually grasp how, this actually flows through the tax return and if it applies to you. So it won't be lost. So hopefully I'll still be able to be entertaining enough to be able to chime in. And I'll bet you it's like reading a book for the second time. You're just going to pick up little nuggets each time that's going to build your expertise. We're also going to cover at the end of the slide just a couple of touch base on some energy certifications or other tax incentives that you can apply to like new construction projects, but we won't touch a lot on it, just very, very lightly. So there's going to be a little bit of a few other nuggets. So let me get to my screen. Okay. So just a little bit about myself so I can earn the right to speak to you today. So I've been with Engineer Tax Services for 15 years now, going on 16. And I personally am a real estate investor. I've been investing in real estate since the late 90s. That might date me a little bit. But it's been a very long time. And I have a great portfolio myself to brag about. I'm also on the tax and the sustainability committees for the Real Estate Roundtable in Washington, D.C. The Real Estate Roundtable is the largest real estate lobbying group in the country, and collectively the members own 72% of all real estate in the country. So I work with very, very large family offices, REITs. You can imagine some of those larger property owners, and we're all on Capitol Hill fighting for you guys. That's been a pleasure to be able to be part of those committees. I also hold multiple board positions, most of them in real estate, and I speak nationally and internationally on a regular basis. So I will tell you that I'm going to come at this educating you about cost segregation today, but I also want you to know that I'm coming at this from a fellow investor. Okay, so if you have other questions about being investors, or I literally have gas stations, cannabis warehouses, hostels, multifamily, short-term rentals, long-term rentals, you name it. I am a deal junkie. So I love real estate. Okay, so if you guys have any questions, I'm happy to answer those for you. So the first thing we're going to do is just kind of set the baseline or the ground for what is cost segregation. Okay, a lot of people think that bonus depreciation is cost seg, and they're not really 100% sure. So we're going to kind of get into that. Essentially, cost segregation is a different method of accounting. Okay, so like if you don't do a cost seg study, you're going to be depreciating your property. Any investment property or income producing property, you're going to be depreciating that over either 39 years for commercial or short-term rentals, or 27 and a half years for residential. Okay, so there's 2 class lives that the IRS requires, and they're classified by the property type and where those are going to go. So if you don't do a cost seg study, you're going to depreciate it over that long haul. And I think if you have $1 million of depreciation on a 39-year class life, I think it's $25,640 a year is going to be the depreciation for that property. Okay. Now, what cost segregation does is, instead of straight line depreciation, we're going to convert that, and we're going to use a different methodology called the MACRS, M-A-C-R-S. And you don't need to worry about what it stands for. It's a tax term and no big deal. But what it does is it allows us to go into that property, and instead of depreciating the whole property over the course of that long-term 39 or 27 and a half years, which, by the way, in this presentation, I will use interchangeably. So if I say 39, I mean 39 or 27 and a half, okay? And vice versa. But what happens is instead of depreciating that whole property over 39 or 27 and a half years, nothing in that property is going to last that long. So the IRS gives us the ability to go in when you purchase a property and carve out certain assets from that building, and we can put them in faster buckets. So instead of depreciating your carpet over 39 years, you can now depreciate it over 5, and the IRS dictates this. And this has come to us through a series of court cases that date all the way back to the 1940s. So this isn't a loophole. This isn't a new shiny toy. This is something that's there. It's established. It's been around for a very, very long time. And there's lots of court cases to support it. Okay. So just know that we're switching you from a straight line depreciation over to a maker's methodology. Now, your CPA won't do this because they're not an engineer. And I've actually seen some CPAs who try to do this and they do it rather poorly, but we want to see, because we have to value each of those assets. The engineer has to come in and break out the value of the carpet or the roof or the insulation or HVAC. And a CPA, that's not their job. That's not what they're going to do. So that's where you have to have a third party come in and actually certify the property. Okay. And that's called a cost segregation study.
Kim, I just want to chime in about 2 things here, just to kind of reiterate what you said. First of all, just for those people new to cost segregation, this is not for homesteaded properties that people are living in. Again, this is only for investment property. So for you realtors out there and brokers and property managers, this is for your clients who have investment properties, not for the home they're living in, only for those investment properties. The second thing I would like to say too is that, for example, when I first started doing this a few years ago with my investment properties, I brought my CPA in. We got on a conference call with Kim. Kim had to walk my CPA through this. I mean, my CPA knew about cost segregation kind of generally, but he's a little more of a, I guess we use the word conservative guy, like, didn't really know exactly how the accelerated depreciation and cost segregation work. So Kim had to walk him through that, show him all the tables and the studies, engineer studies that were done on my properties. And he is on board with it now. In fact, he now refers clients, his other investors, onto this to give value add to them as well. So just kind of understand that sometimes you got to drag your CPA along to the well. Sometimes you got to bring the horse to the water and not vice versa. So yeah.
Yeah, and sometimes kicking and screaming, right?
There you go. Sometimes, yes.
Yeah. So I love CPAs. I do. I think they're just so fun to work with, and to be able to show them how they can actually present this to their clients and provide value, I think it's a no-brainer. So I love working with CPAs. So I'd love to work with your CPA as well. But anyways, this chart on the screen right now just is giving you the depiction. Instead of depreciating it as a whole entire building as one unit, we're actually going to break down all the different units and the components inside and outside the building. And then we're going to assess different values to it. And I'll show you that a little bit later in the slide. So I get into the why, like why would we do something like this? And there's a couple of different reasons. Obviously, one, you're going to get accelerated depreciation. So that's a benefit. You're going to get more depreciation because there's going to be shorter buckets. Okay. The second thing is, and I think this is very important, is that the IRS writes what's called the audit technique guideline. And they write these guidelines, and they're like a Bible for their auditors when they go out to do an audit, and an audit has something in it that might be complex. They actually write a guide that says, this is how you audit for this. Now, there's an audit technique guideline for cost segregation. And in that audit technique guideline written by the IRS says that the maker's methodology, which is the cost segregation, is the preferred method of depreciation. And you'd be like, why would the IRS want that to be the case if they're getting, less money because you're taking more depreciation? And the reason is because it's more accurate. Now they're not going to tell you this, but because certainly it's like, okay, do you if you want to do straight line depreciation, that's fine. But the preferred method is this. Let me give you one example of why this is accurate. When you have your property broken out like this, let's say you buy the building and it has a roof, right? And then in 5 years, you replace the roof. Now the IRS requires that you have to capitalize that roof as well. So you've already capitalized it when you purchased it. So you're depreciating your roof when you bought it. And then when you put on a new roof, you put on another capitalized roof, and now you're depreciating 2 roofs, one of which does not exist. That's not very accurate. When you do a cost study, you break down the cost of the roof, and then you put on another roof, you actually get to take what's called partial asset disposition, and you write off the remaining depreciation of the old roof. That's called partial asset disposition. And so that is one of the reasons why the IRS says that this is the preferred method of the IRS, because they want to see the more accuracy in the books matching what's actually happening in the building. Okay. So obviously we get to optimize the annual write-offs, repairs and maintenance, routine maintenance, the asset demolition or the partial asset disposition, like I just mentioned. That's another reason why we would want to do this. And then the bonus depreciation. And probably you've heard that term potentially if you're in real estate, but you may not know exactly what it is. And I'm going to make you wait a little bit longer. I'll probably sound like an infomercial. Wait, there's more. But by the end, I'll make sure and explain it to you so that we can differentiate the difference between cost seg and bonus depreciation.
Well, that's where the juicy stuff is in that bonus.
Yeah, that's where the fun stuff is. Yeah. So let's kind of talk about who's a good candidate for cost seg. You're going to see my hands flying. If I did not have hands, I would be mute. I just tell you so. Hopefully that's okay. But who's a good candidate for cost segregation? So this would be, as Jerron had mentioned, any owner of a commercial or investment property. So it has to be an income producing property. If you have a primary residence or a homestead, or you have a second home, something like that, that's not a candidate for cost segregation. And so basically, if you have an income producing property, whether that's commercial or residential, a short-term rental, a long-term rental, and you have income coming in, then you're depreciating that asset, and that's when we can go do the cost seg study. But you don't have to own the building. Let's just say let's say you rent a space in a strip mall, and then you opened up a dental practice, right? And you went in and you put in $500,000 worth of improvements into that space. You're leasing the space, but all your equipment is in there. You can do a cost seg study on the improvements, the leasehold improvements, as long as they're over $50,000. And you don't even have to own the building, because you are depreciating that asset as an improvement. And so therefore you can do a cost seg on that. And we can break out the difference between the 5 or the 15-year property there. Anyone who's paying federal or state income tax, obviously, if you own property. If you're operating for profit, that's a no-brainer. Obviously, if you're a REIT, you don't pay federal tax, but I do have a lot of REITs who do cost segregation because they're offsetting the state tax that they have to pay. So we do actually work with quite a few REITs, especially in my real estate roundtable group. Now, owners are applying to hold an investment property for less than 1 year. So this would be like a flip, not a good candidate. Okay. So if you're going to do a flip, why is that a not good candidate? Because you never really hit the books with the depreciation. You buy the property, you renovate the property, it doesn't go into service, so it never hits your depreciation schedule, and then you sell it. So there's no depreciation actively being taken. You just literally bought it and you never put it in service, and you flipped it when it was done. So it's not a good candidate for that. But if you plan to own a property more than a year, I would absolutely do a cost seg study. Now, there are maybe some extenuating circumstances where I would recommend not to do that, but as a rule of thumb, if it's going to be held more than a year, I would do it. So we have a motto at ETS, and I use it quite often. We do believe that everyone should pay tax, but there's nothing in the code that says you have to leave a tip. And this is actually printed on the back of my business card because I love taking the tip off the table. And Jerron will tell you, I will geek out on taxes. Like, I love it. And as a real estate owner, as an investor, I don't let very many people touch my money because I feel like I do a way better job with my investments than any person, third party could or has done. And every time I give my money away, sorry if there's any wealth planners on there, but every time I give some money away for somebody else to manage it, So I'm
Yeah,
like, well,
well,
I could have done better than that.
yeah, and I tell you, after being a real estate attorney here for 14 years, I've come across a lot of very highly successful clients who own, dozens, sometimes hundreds of units, even a few clients that own thousands of units, and other types of assets as well. And I always try to pick their brain on how they became successful, what they're doing now with their success. And one of the things I've learned from especially the most successful, my clients monetarily successful, is that the game that they're playing, it's a multi-pronged game. Of course, there's the game of investing and finding good assets and improving them and selling it at the right price and all those good things. But it's the game of the tax game, legally avoiding paying taxes. That is what the richest and wealthiest Americans do. And, this is just one of those methods and one of those arrows in that quiver of legally shielding money from taxes. So, definitely a game that I've opened my eyes to and now starting to play myself. And a number of our clients are doing that as well, which is great. I do have one question from Debbie here for you before we keep going. She says, do you have to do the cost segregation as soon as you purchase, or can you move to this 10 years after you bought the property? Also, do you have to go back and redo previous taxes? Good questions. Yeah.
Yeah, great question. So if you still own the property, you do not have to file an amended return. You can still do a cost seg study. And then the IRS gives us a tool called a Form 3115. And what that does is it's a reconciliation between the old depreciation and the new. And then you get to bring that forward into your current tax year. So if you've owned a property for 10 years and you want to go back and do a cost seg study on it, you can, and then end up just doing a 3115 and bring all the benefits into the current tax year. So there was another part to that question.
It was, do you have to go back and redo previous taxes?
Nope. It just carries it into the current tax year. So you can only file a 3115 on the current filed return. You can't put a 3115 on an amended return. So the IRS gave us this tool and said, okay, we can reconcile the depreciation and then we're just going to bring it forward. So you would file it, let's say in your 2024 tax return, but you're going to make up the depreciation from all the previous years you've had. So you don't have to go back and reclaim or redo or amend any taxes. Okay.
Great. Yep. And I remember doing that with you. I think it was 2 years ago. We went back to my 2020 taxes in 2021, and you worked with my accountant to get that all done. So we kind of looked back and recaptured that depreciation that I had the ability to capture then. So that was great.
Yeah. Awesome.
Okay. Well, good. Thank you. I think yes. Okay. Debbie said thanks. We're good. We can move on.
Okay, perfect. So here are the types of properties that are beneficial. So we have new construction. If you're newly constructing a building, that'd be a great candidate. If you're doing renovations, assuming that you're doing renovations about $50,000 or more, it's a very low threshold. Existing properties. So if you've owned property for the last 5-10 years and you want to go back and do a cost seg, we can. And again, just do the 3115 to reclaim it. Let's see, recent or new acquisitions or purchases, obviously. So yes, you want to do those in the year that you purchased it is always best and most recommended, because what we're doing is we're actually establishing a baseline and proving to the IRS what was there at the time of purchase. So that's why we say to do that, but it's not mandatory, and the IRS does give us the ability to go back and do that retroactively. Leasehold improvements, like we talked about, so about 50,000 or more. And this is an interesting one, especially right now where we have the largest transfer of wealth with our baby boomers now starting to pass away. A step up in basis or some sort of inheritance. So if you have a partnership buyout and there's a step up in basis, or if you have a family member that passes away and leaves you with some property, you'll have potentially some estate tax that you'll need to pay, and we can do a cost seg and help offset some of that. So that's a great opportunity to do a to do a cost seg study. And then also 1031 exchanges. So if you do a 1031 exchange, if you have excess basis, then we can do another cost seg. So even if you have a property and you did a cost seg study on that property, and then you 1031 out of that property into another property, and whatever that excess basis is, we can do a cost seg on that again. Okay, so just so you know that that's a really good opportunity. Now I'll show you the chart because this chart is very helpful to combat some of the myths. So we have some myths in cost segregation. A lot of people are not clear. And so I get a lot, I think like 10 or 12 years ago, I wrote an article about debunking the myths of cost segregation, and this was part of it. But the blue line, well, let's start with the yellow. The yellow line is your straight line depreciation. It's super, super boring. And essentially, you get your property and you depreciate every single year the same amount for 39 years, and it's static, right? So your CPAs love it because they're very, their personality is like, nope, we can count on this. We know exactly what it is. Chunk, chunk, chunk. But I'm sorry, as an investor, I just cannot depreciate my carpeting or my specialty electrical and chandeliers and that kind of stuff over, a 39 period of time. It's just not going to work for me. So I choose to do the blue line. The blue line is cost seg. So one of the myths is that you're going to take all your depreciation up front. You're not going to have any more depreciation in future years. And that is not true. So what happens with the cost seg traditionally is that you get a big bump in the first year. So like in this case, instead of 100,000 in deduction, you're going to get 600,000. Okay. And then it starts to drop off after that 5th year, and it drops below that yellow line. But if you really notice, you're only dropping down just a titch. You still have depreciation. You might have 80,000 instead of 100, but you took that big, huge bump up front. And then again, in year 15 or 16, it drops again, but again, you might be down to 75,000, right? So it's very little difference because you're pulling the depreciation from future years into those buckets, and that's what's happening. So you're only decreasing your depreciation in future years a little bit, which as an investor, I would much rather have my money now than have the IRS have it for 29 years or 39 years, okay? So I did an example. This, Jerron would probably appreciate this because he's seen this probably 100 times, but the benefit analysis is a property. The facts of this one, essentially, this is a smaller property. Purchase price was $518. It was bought in 2023, so it's eligible for 80% bonus depreciation, and we use a land value of 30%. 80% bonus depreciation. I think that's what I said. And again, there's that bonus depreciation word. We'll talk about that in another slide. But again, we're still setting that baseline. So in this particular example, column B is your straight line depreciation. This is your static. Now, the first year, they only owned it for 1 day. So they had very, very little depreciation because the straight line depreciation is prorated. And so they only owned it for a day. They got, $387. And then every year after that is that static $9,200. And this is exactly going to show you what I reflected on that last slide where the chart is. By doing the cost seg study, we were able to get 80% bonus, and then he was a $76,000 tax deduction the first year, and then 12, and then 10, and it doesn't really flip-flop lower. Do you remember? Now we're dropping down below that yellow line. It doesn't drop until 2026, and then it drops a little bit more and a little bit more until you get into here, 2029. You're still only, less than $2,000 or about $2,000 in depreciation different than you would if you didn't do that. But look at all the excess you get. Okay. So
and Kim, I think the key here for why investors really do this is because I had this, I won't call it an argument, but I had a debate with my CPA about this. And my CPA said, Jerron, your income is such that it might be good to have more depreciation over the 27 years to offset your ongoing income. You're not planning on retiring anytime soon, although some days I wish I could retire at my age. But my counter argument, which I went with my gut, is that I want that significant chunk of money that I can get back. So let's say if this was my scenario, I would want that $76,000 in today's money for two reasons. Number one is I can invest that money in something else, whether it's more real estate, which typically is what I go towards, but I have some other investments, maybe equities or whatever the fund is. Even I can put it in a money market fund for 5% per year, rather than letting the government hold on to that money. The second thing is that, as we've seen for the past 100 plus years, the dollar is depreciating every year. We just saw a ton of inflation in 2020 and 2021. So the value of that dollar, if you're waiting 27 years, is not worth waiting for. So those are the two reasons that I love this, getting that chunk of money up front so that I can go make it work, and that money snowballs year after year after year when you're investing it in something else, rather than waiting to do smaller amounts of depreciation over 27 and a half years. That was my logic, and I think a lot of investors' logic. Would you agree, Kim?
Spoken like a true investor. You always know the true investors when they catch that, because CPAs, they just don't. I mean, I'm not saying all CPAs don't do that. There are some that are investors and they get it, because I work with a lot of them, but but most of them are they just chink away, right? And they don't think about it in those terms. And let's why does the IRS allow us to take the depreciation up front? And really, realistically, it's because the assets that they're allowing us to put into faster buckets aren't going to last that long. So if you're going to replace your carpet 15 times over the course of 39 years, or every 5 years, what does that look like? Maybe 5, 6 times. You don't want to be depreciating your original carpet over 39 years. It doesn't make any sense, because you're going to replace it. So same thing with roof, and nothing is going to last. Let's say you buy a building that's 20 years old. Your roof isn't going to last 40 years, 40 more years, right? At some point in time, you're going to have to replace that roof. So absolutely the time value of money. I always like to give the analogy of, like, if you scratch a ticket, a lottery ticket, and you win $40,000, and you go to the lottery commission and they say, we'll either give you, $37,000 right now, or we'll give you $1,000 a year for 40 years. Like, I know this is the perfect example, because I know with $40,000, that could be a down payment on another property. I could hire another employee to help me make more money. I could, invest it in something. But if I got $1,000 a year, I would literally eat it, because I would spend it on groceries, because it's not enough to do anything with, right? So that's what we're talking about here, only on a bigger scale. This is some of the detail in the reports. When I say we break down everything, we break down everything. Here's like a custom chandelier, for instance. Okay, it gives you the count of how many there are, what class life it belongs in. This is just one page of about 50 that we've returned, but it's very, very detailed. So let's chat a minute about passive versus active. And I'm just looking at
Kim, can I interrupt you here? We have a couple more questions.
Yeah.
So Andrew says, how does this apply if you live in the unit for a year or two? So it is homesteaded, no amortization benefit. Then you move out and rent it out. What happens in that case?
Yeah, Andrew, that's an awesome question. So if you have a homestead that converted to a rental, at the date that it converts to a rental, you begin depreciating that asset. And your bonus depreciation rules and everything are going to default to the year you purchased it and the year it was put into service. And so you can do that. Now, I also get this question with people who have like a homestead, but then they rent their basement out on an Airbnb or something, right? So what I typically recommend, let's do a cost seg on the whole property. And then what we're going to do is we're going to take the percentage that is your rental, and we're going to depreciate that part of it and apply the cost seg rules at that percentage, the ratio. Okay, so you can do that because you're depreciating some of the space. Did you want to go to the next question, Jerron?
Yes, absolutely. What is the tax implication, if any, if the property is sold in year 2028 after you've taken a $78,000 deduction in year 2023?
Yeah, this is a great question too. So what we're referring to is recapture. So what happens if you sell the property and you've taken an accelerated depreciation or bonus depreciation, and then you sell the building? So you just have to get strategic. Okay. So yes. So bonus depreciation, I know we haven't really gotten into bonus yet, but just keep this in mind. Bonus depreciation is an extra on top of the depreciation that we allocate in the different buckets. And I'll explain that in a little bit. But essentially you're getting, of the faster buckets, you're getting a percentage of it right now. You don't have to wait. So it's kind of like an advance on a paycheck. You go to your boss and you say, hey, I'm going to start working for you. I want you to pay me 5 years up front. And then you quit your job in year 2, you're going to have to pay back 3 years of wages, right? Okay, same kind of thing here. You're taking an accelerated depreciation because of the bonus. Not always. It's only if you elect to take the bonus. You take that up front. And then let's say you sell the building. Well, the IRS is going to be like, hey, you took your bonus depreciation. You didn't, own that property as long. And so there's going to be recapture to pay. But there's a couple things here. One, you get to take the deduction at ordinary tax rates. And when you give it back on recapture, you're giving it back at capital gains rates. So essentially you have a 10 to 15% arbitrage right off the bat. If you don't do anything else, that's worst case scenario. So essentially you got to borrow money from the IRS for 4 or 5 years at 0% interest, and they pay you about 10% when you pay that back, when you pay it back, right? So, if you guys are out there going getting HELOCs or loans or anything for improvements, think about doing this instead, because it's basically free money from the IRS that you get to use for that period of time. The other thing is that's worst case scenario. Now, what you would normally do if you took a large number of deductions upfront and then you sold the property, which I have done multiple times, by the way. And then what you could do is you just do a 1031 exchange into another property, and you don't have to pay that recapture back. It just gets rolled over into the new property. So thank you for your question, because recapture is a big topic. And that was also in my article that I wrote about the myths of cost segregation. So
yeah, and 2 comments on, well, 1 comment, 1 question. The goal, I think, of a lot of investors is to keep kicking the can down the road, so to speak. And so let's say you own a property, an investment property for 7 years, and then you sell it. You're going to do a 1031 to roll it into the next property, so you don't have to pay that depreciation back, that recapture back to the IRS. And then that property, of course, has a higher basis, and you keep growing, and the asset value grows, and maybe you keep that another 10 years, and you sell it, and you 1031 it on to the next property. So you're not paying any of that money back. And then ultimately, tell me if I'm wrong here, but upon your death, in many circumstances, your children do not, the basis, the step-up basis comes up to a point where they don't have to pay back that depreciation. Is that correct, Kim?
If it's structured right, yeah. If you got the trust,
there are ways to do it. Right.
Yeah, there are ways to do it. Yes.
Okay. We don't have to get into estate planning right now, but there are ways to do that.
Yes,
one other thing I want to ask is, what about the non-bonus depreciation? Let's say you sold a property, you didn't use a 1031 exchange. Would you have to pay the non-bonus depreciation back?
No.
Okay, got it.
There's no recapture on the long-term asset.
Perfect. Okay.
Okay.
Move on.
Okay, great.
Thank you.
So we're going to talk about passive versus active a little bit. There's a whole stuff behind this. There's a lot to it. So I'm just going to give you quick snippets. If you qualify as a real estate professional status or reps, that means you're actively managing your real estate. You spend at least 750 hours a year doing real estate, and usually more activity than any other job. So if you have a W-2 job, just make sure you spend more time managing your real estate. Then you can be a rep status. And what happens is this massive front load of depreciation offsets your household income. Let me give you an example of this. I work with probably 700 or 800 doctors. I am part of a group. All they do is invest in real estate outside of their practice. And what they've done is taught them in their university that, you make your spouse, who is not working in this case or working part-time, as them being the real estate professional. And that gets your reps status. And that person who's essentially staying home and managing some of the real estate investments for the family, now they have this huge tax deduction of $700,000 or whatever it is. And that $700,000 comes in and offsets the W-2 income for the household. for the doctor. Okay. So rep status in a household when you're filing a tax return married jointly is super, super powerful. Or if you can yourself be that real estate professional, it's very, very beneficial. Then material participation. Now, this is strictly for short-term rentals. Okay. It acts as though you have rep status, but it's only if you have short-term rentals and are actively managing that short-term rental. You only have to spend 100 hours a year for material participation. And the same thing will apply that if you have that short-term rental, you now have a large deduction from the cost seg study, and that offsets the household W-2 or ordinary income. So there is it is known as the material participation or short-term rental loophole. Okay. So just so you know that that's what that is. Andrew had another question. He says, is it worth it to do it if you buy a property in the middle of the year, leave it vacant for the rest of the year, and next year decide to live in it so you homestead it? Tax benefit. Okay. If you have a property that is not generating income, so it's empty, it will not be depreciable. So you can't do this. But if you rent it out a few times and you do generate income for that property, you start to depreciate it, and then you move into it, your depreciation just stops. You don't have to pay it back. You don't have recapture. It just stops because you technically still own the property. It's just not a depreciable asset when you move into it. So there is a really smart play here where you can get in, furnish a home, rent it out on Airbnb for, a few months and establish that, and then turn around and move into it later. So you can get some really good tax deductions. Another one is if you can't get the real estate professional status, but you can get the short-term rental, you start a short-term rental and then you convert it to a long-term rental the next year after you've taken all of your deductions in the first year, or a lot of them anyway. Lots of ways to do it here. And then, of course, passive investors. Okay, so passive investors over here, essentially, you don't have rep status, you don't have short-term rental material participation, but you own rental property, and essentially the cost seg still works. It's only going to offset the income from the property, though, so you just won't have to pay tax on the income. I'd say most of my passive investors will eat up the deductions in 2 to 5 years, so it actually works very, very well. So I would say another myth is that if you're a passive investor, that cost seg isn't going to work for you. And I think that's hogwash. Because here's why. Here's another tip. Let's say you own 3 properties and you took depreciation, accelerated depreciation. So you did the cost seg study and you have lots of depreciation. It's sitting there in a passive carry forward, and you use what you can and then it rolls over next year. But then one of those properties, let's say in year 3, you sell it. As soon as you sell it, then you actually get to take all of the depreciation that you've banked up and it converts to active. So now you just offset your active income. So many CPAs miss that box when you dispose of a property, that you don't get to take the losses against your W-2, but it is a true fact. And those that are in tax who know it are very valuable for their clients. So okay, now we're going to get into bonus depreciation. So the bonus depreciation, it has been around since 2006, actually, but it was really for new construction and it was only 50%. And it wasn't until the Tax Cuts and Jobs Act in 2017 that it was enacted with President Trump that we would increase the bonus depreciation to 100% and expand it to include purchased property or used property. And that changed the entire game for investors. So now we can take 100% bonus depreciation. This was for properties that were placed in service after September 27th of 2017 through December 31st of 2022. And we had 100% bonus. So if your properties fall in those dates as a placed in service, you would be eligible for 100% bonus depreciation even now. What that means is, do you remember in the very first slide I said when we carve out the assets, we're putting them in different buckets? There's a 5-year bucket that's usually reserved for interior finishes. And there's an external bucket, which is 15-year, which is like all of your finishes outside, like irrigation, driveways, parking lots, you know, that kind of stuff, landscaping. And so there's usually typically is a 5 and 15-year bucket. Well, this is what's interesting. Normally, when you carve out the assets and you put them into these buckets in 5 and 15 years, now you have to depreciate this amount over 5 years, not 39, or 15, not 39. But then it gets better, because with the bonus depreciation, they say anything that you put into a bucket that's 20 years or less, which includes the 5 and 15-year buckets that we just talked about, you get to take 100% of that up front. You don't have to wait 5 or 15 years for it. You get it all right now. That's the advance on the paycheck that I was talking about. So you basically get to take this huge income, you know, or deduction, so that it offsets your income, and you get to play with that, okay, for those 5 and 15-year buckets. But then it starts to sunset. Okay, so in 2023, the 100% dropped to 80%, and right now it's 60%. So now what they're saying is, of those 5 and 15-year buckets that are established in the cost seg, you can now take 60% of it up front, and then the other 40% gets allocated respectively between its 5 and 15-year buckets. And you obviously still have the long-term bucket too. So the bonus depreciation can be extremely valuable when you can take so much of that up front. That's the loan I'm talking about. You get a loan from the IRS at 0% interest, and in many cases, they pay you to be able to take the money and play with it before you have to give it back when you sell. So I cannot tell you how valuable this tool has been, just personally to me and my family, because I had a lot of real estate, but I've been an investor, as mentioned, for so long. I have literally used bonus depreciation since the inception, and we have multiplied our net worth tenfold since these have been enacted. So no double your money in 7 years. We're like double your money in a year. Okay, so we are very, very grateful for these tax rules. And 2025 purchases would be 40%, then 20, and then in 2027 it will sunset to 0. There was a bill to bring this back to 100% recently. Died in the Senate, but not because of the bill. I'm sorry, not because of the bonus depreciation. That was actually bipartisan, and they do want to pass this, but it was coupled with the very controversial child tax credit, so it died. And so we're going to repackage this, working with the Real Estate Roundtable on this with new bills coming up. So
It would be amazing if we could get that through next year, whoever's in the White House or Congress. So yeah. Hopefully,
yeah,
fingers
well,
crossed.
this is not it's not a party line type of thing. Bonus depreciation, like I said, has been around since 2006. So
But
through Democratic Party and Republican Party, this is bipartisan. Everybody wants it back. It's just a matter of packaging it in the right way, that they can get it. So I don't think any reason why it won't be coming back. So I would
do
imagine.
you think there's any chance it could be retroactive for the years where it lowered here, like
That's the
24?
way that's the way they wrote it, that it would be retroactive to 23 and 24 at 100%.
And let's say we did depreciation already, the bonus depreciation, let's say this year, which I'm planning to do at the 60%, would we just need to come back to you to amend those taxes again? Is that kind of probably?
Oh, no, I wouldn't have to do anything. Your CPA just does a
CPA?
reconciliation, and they just pull forward the extra bonus that they would get as soon as it passes. Yeah,
Makes
it's a
it
very,
even
very
easier.
quick fix, really easy.
Perfect.
Yeah.
Okay.
Yeah.
Great. Thank you.
Yeah, but you have to have the cost seg study done. So make sure you get that. Okay, so we're going to move on to energy if you have a minute. I know that we've got about 15 minutes, so I can fly through it pretty quick, or we can stop here and then just answer questions. What are your thoughts, Jerron?
But why don't we try to fly through it pretty quickly? And you know, if we get questions that sidetrack us, that's great. I always want to answer people's questions. And one other thing is that, you know, anyone who's asking here about the outline of the slides and the recording, we'll send those after the class on to everyone via email. So, but yes, let's keep chugging along here, Kim. Thank you.
Awesome. Okay. So the energy certification, there's 2 that we can do. Okay. There's one that's called, and this is super complicated, so I'm just going to give you some slides and try and go very high level on this. The 179D, okay, is I would say reserved at this point in time for new construction. Okay. I would say new construction of commercial property or residential property that is 4 stories or more. Okay. So multifamily, 4 stories or more, or commercial property. All right. If you construct this, there is an incentive. It's called the 179D, or this has been around since 2006. And essentially, you can get up to $5 per square foot as an additional tax deduction on top of your cost seg study. Okay, so whatever the square footage is, you can get on top of that. Now, you would have to meet some labor standards like prevailing wage in order to get the maximum benefit. But if that property performs at an energy efficient 50% over a reference building better, then you can meet that $5 a square foot and get that as a tax deduction. So that a lot of people don't know about this. And these are the new rules. The old rules from 2006 through 2022 were only a max of $1.80 per square foot. And we just bumped it up to $5 a square foot and added that prevailing wage. So there's quite a bit of benefit there if you're construction or development or, you know, building an office or whatever you guys are doing. Okay, so that's the 179D. That is a tax deduction up to $5 a square foot for commercial property or multifamily that's 4 stories or more. Okay. And the reason I preface that is because there's another one. This is the 45L. This one is reserved for residential. I would say new construction or substantial rehab, meaning full gut rehab. Okay. Not just going into multifamily and like fixing some cabinets and countertops, like full on, you know, reno. This is different. This is a tax credit, not a tax deduction. So if you know the difference, a tax credit is a dollar for dollar offset against your tax liability, whereas a tax deduction will reduce your income and then you pay tax on what's left. So a credit is way better than a deduction. This is a $5,000 credit per unit. So if you're building multifamily, and this is any size, let's say this is 4 stories, okay, 4 floors, and you're constructing this, you can do the cost seg study on the building, you can do the 179D because it's multifamily 4 stories or more, and you can get the 45L. So you get the cost seg, the 179D, and 45L on this property if you meet prevailing wage. Okay, so $5,000 per unit. And essentially that's reserved for new construction or substantial upgrades or renovation. Okay, so I just wanted to tickle you with that a little bit because they could be very valuable if anyone on the call is doing any kind of development. Okay, so that was it. I just wanted to go through all of that information, and then my contact information is on the screen and we can answer some questions.
Perfect. Excellent. Thank you, Kim. That was great content. Anyone else have any questions? If you do, feel free to type those questions into the chat box here. We'll give it another 30 seconds or so, and happy to answer those questions if you do type them. If not, we can end the presentation here. But very valuable information. And for all of you who are realtors or brokers, even your property managers, you definitely want to be at least informing your clients about this, maybe having just a very high level conversation with them. You don't have to be experts on this. It may just be a conversation that they want to have with Kim. Even if they decide not to do it, at least they're informed and they understand that the type of benefits that they can receive from this, it just makes you look that much more valuable, that you're providing value to them, to your clients. So that's my recommendation. It's what I do with our clients here.
Sure.
I don't see any other questions here, so I think we'll end the presentation. And for all of you who have asked just one more time, we will go ahead and email you Kim's contact information. We'll email you a link to the recording of this webinar, and we'll also send you an outline of the presentation as well that Kim will provide to us. Kim, awesome as always. Thanks again for your time. And if people have private questions, I'm sure they can email you privately or call you. So.
For sure. Thank you so much. I appreciate doing it. We love doing webinars for you guys, and I'm here if anyone has any questions.
Perfect. Excellent. Thank you, everyone. Appreciate it. Have a wonderful day.